Let's explore how Federal Reserve policy, liquidity, and volatility work together to shape biotech valuations. This framework shows three key dimensions: price peaks before volatility spikes, policy transitions drive the biggest swings, and stable conditions don't guarantee recovery. Fed policy shifts sit at the center, triggering price peaks first, then volatility spikes, while liquidity expectations set the discount rates that determine valuations. The pattern repeats: prices peak, volatility spikes follow, and then policy tightening kicks in. Here's the paradox: stable conditions calm volatility, but they don't improve valuations when rates stay high. Price direction ties directly to liquidity expectations, not just whether policy is stable. Biotech behaves like a duration asset, reacting to interest rates and liquidity just like long-term bonds. Now let's look at what happens when policy pivots without liquidity improving. Low volatility can trap the sector in low prices, where calm markets hide the real problem. Regulatory shocks and crowded trades both threaten trapped valuations, risks that often go unnoticed. This chart overlays Fed rates, XBI volatility, and XBI price from 2006 to 2025. Notice how price peaks come before volatility spikes, and volatility drops during rate plateaus while prices stay flat until liquidity returns. Volatility doesn't react to where rates are, it reacts to where they're going. Policy direction matters more than the rate level itself. When the Fed holds steady, volatility compresses. But when policy shifts from easing to tightening, volatility spikes fast. We see this in 2015-16, again in 2018 during quantitative tightening, and most dramatically in 2022. Pre-2012 biotech was heavier on large caps, while post-2012 biotech has more platform and pre-revenue names, making it more sensitive to macro shifts. Now let's turn to the math behind price movements, discount rates, and liquidity. Volatility reflects policy transitions, but price reflects the actual valuation impact of discount rates on future cash flows. When discount rates fall or liquidity increases, valuations expand. When funding gets expensive or capital becomes scarce, valuations contract. In 2023-24, volatility collapsed after policy stabilized, but prices didn't recover because high rates still depressed valuations. Volatility calms when policy stabilizes, yet prices stagnate because high rates still suppress valuations. Price recovery depends on the forward path of rates, not just current stability. Investors are no longer panicking. That's why volatility is low. But they aren't bidding up the sector either. Liquidity conditions, more than anything else, determine biotech's long-term price direction. The 2010-2015 and 2016-2021 rallies both emerged from abundant liquidity and low discount rates. Cheap capital, strong innovation, compressed risk premiums, and rewards for long-duration assets all converge to drive biotech rallies. The 2020-21 stimulus period intensified these dynamics, with zero rates and unprecedented support. When liquidity reversed, the valuation framework collapsed, leading to the 2021-22 drawdown, the worst in ETF history. Liquidity direction determines price direction over the long term. Here's the most important observation for the current cycle. Stability reduces volatility, but doesn't generate price recovery. In 2023-24, the Fed kept rates high but stopped tightening. Financing stabilized and volatility sank. Yet we see low volatility alongside low prices, calm markets without valuation expansion. For biotech, stability isn't enough. It needs declining rates and improving liquidity to produce a durable rally. The 2018-2019 mini-cycle shows the same pattern. Volatility eased only after the Fed paused and pivoted. Let's synthesize this into a coherent model of how volatility, price, and policy interact. Volatility acts as a regime shock index responding to policy transitions, while price acts as a liquidity index responding to capital availability. Regime transitions trigger volatility spikes. Then, when the Fed pauses, volatility collapses. During liquidity periods with low discount rates, prices rise. And when the Fed cuts, prices recover sustainably. Sector tops almost always precede volatility spikes, which cluster around moments when sentiment turns. Over 2 decades, biotech behaves like a duration asset, driven by liquidity and discount rates, despite its event-driven nature. What does this mean for the future? The sector may enter a stretch of low volatility with capped prices, where calm markets persist without valuation expansion. A policy pivot alone won't spark a rally without improvements in risk appetite and financing flows. Sector-specific factors like cyclic science, regulatory shifts and platform waves can amplify or mute macro effects, but rarely override them. Crowded sentiment at peaks continues to signal regime shifts, a pattern worth tracking deliberately. The glossary defines key terms like XBI, Fed, and quantitative tightening, while disclosures clarify data sources, risks, and the educational nature of this analysis.